So I was reading a story the other day about a company that many analysts are saying could be the next Amazon. And it gets annoying. Every time I read something, it's like, this company could be the next Amazon. This company could be the next Tesla. And yeah, a lot of companies have potential, but most of them can't execute on it. However, this company, I think, is a little different. And Carvana recently announced their earnings for the last quarter. And a lot of analysts are saying it can be the Amazon of the car space. So this e-commerce company is an online retailer for cars, buy and sell used cars. And the e-commerce company has seen its sales grow exponentially since its IPO in 2017. And a lot of top hedge fund managers have large positions of this company in their portfolio. I mentioned it a while back on our main channel, but either way, this company has been doing extremely well, especially with everything going on in the pandemic. Used cars, people, don't want to spend as much money, so they look towards used cars. On top of this, people are looking to buy and sell a car, buy a car online, and Carvana has that as well. So as of the fourth quarter in 2020, Carvana was one of the top 50 favorite stocks of hedge funds, and the only stock with more top 10 appearances and a smaller market cap than Carvana's $21 billion market cap was a SPAC that a lot of people have been talking about recently, which is Lucid Motors and their merger with Churchill Capital, stock ticker symbol CCIV. And by now, Lucid Motors has a much higher market cap than $21 billion. So this is the lowest market cap stock that is the favorite out of many top hedge funds and just investment banks right now, a lot of institutional investors. So hedge funds with major stakes in Carvana are companies like Tiger Global. They have 6 million shares, about 8.5% of the company. Spruce House, D1 Capital, Lone Pine Capital, all these different companies comprise about 25% of the total market cap of Carvana. And what I like about Carvana in particular is that right now at a $21 billion market cap, it's going into an industry that is only going to continue to get bigger. Buying cars online is going to continue to be more and more important. We see Tesla. You can only buy a Tesla online using their website, and Carvana, especially with people looking to save money with used cars, Carvana is an ideal place for people to look to get cars. But, so on top of all this, with Carvana, a company like them, the more people that are aware of it, the more inventory they have, the more eyeballs and the more customers and more revenue that they could generate. So the more distributed their inventory is, the more inventory they have, the bigger they can get. So it's a virtuous cycle. More people who look at it, more people who list their cars on it. More people who list their cars on it, more people who will buy cars. So as they get bigger, it's just a virtuous cycle that keeps feeding it, and it keeps growing and growing the company. So according to FactSet, 65% of the analysts that cover Carvana give the stock a buy or overweight rating. None of them have sell ratings. And according to most analysts right now, the average price target is around $320 per share. Currently, Carvana stock is sitting at $283.50 per share. Since its IPO, it has done extremely well. It is up, since its IPO. At one point, it was at around $20 a share just a couple of years ago. So it's over 10x since then. If you look in 2018, or even if you look at, earlier this year, earlier in 2020, they were at $29 a share. So they've 10x since early 2020, about a year ago. But analysts still think they have a ton of upside and can be the next Amazon of the used car space, Amazon of cars. And, you don't want to use this term lightly. I'm not just saying this because it gets annoying when people use this term a lot. But I really think that they do have a lot of potential. They have a first mover advantage. They are really differentiating themselves from their competitors, and they're just not like the other car companies out there. So let me know what you guys think of it. But this company, I actually do think at a $20 billion market cap has so much upside in the industry that they are in. But speaking of cars, so a car company called Fisker, their stock ticker symbol is FSR. And the other day they announced some big partnerships. One was with Foxconn. They announced partnership with Foxconn. And that one would enable them to eventually make 250,000 vehicles or more annually each year. Foxconn is a major partner of Apple as well. So this has driven the stock price up significantly. On top of this, just a couple of months ago, they also had a major partnership with Magna International to help them make their first electric vehicle, which would be called the Ocean. That's the name of their vehicle. It would be called Ocean. So they've been having a lot of deals recently, but they're not just trying to be, a little company compared to Tesla. They're not just trying to chip away at Tesla's market cap. According to a recent interview with the CEO of Fisker, he spoke with CNBC and he said that there's a real market opportunity out there in the customers who buy a new car every year. They're not just looking at electric vehicle owners, not just looking at Tesla owners. They said that every single year, 80 million people buy a new car, and that's a gigantic opportunity. Tesla can't just produce enough vehicles for that. They made 500,000 last year. He said there's not one car company out there that could simply meet that demand, and they're trying to be a major player, capture a lot of market share in that space, and they're not just trying to chip away at Tesla's market share. They're trying to, hopefully beat them. And right now, their market cap is sitting right around $7.9 billion. Recently, in the last couple of days, the stock price is up about 57% in the last week alone. And this is mainly driven because of that massive partnership with Foxconn that would enable them to have sell vehicles in the U.S., in Asia, in Europe, and it would eventually lead to them having another 250,000 vehicles produced annually. So in this interview, it's just pretty important because now with this partnership with Foxconn under the project name called Project Pear, they're going to be working on that EV. They also have the partnership with Magna to work on their EV called the Ocean, and they're making a lot of major moves in the space, and they don't have goals of just being a small little competitor to Tesla that chips away at its market share. No, they're trying to be their own major company. They're looking at the total vehicle sales each year, and they're trying to attack that, not just say, I want to look at electric vehicle owners and appeal to them. They want to be a car that the broad market can actually buy. So obviously, they're going to have to come in at a lower price. They're going to have these major deals, which they are continuing to get. But a $7 billion market cap, they are pretty expensive if you're looking at them in terms of what they're doing now. But long term, with the technology they have, with these major partnerships with Foxconn and Magna, they do have a lot of potential at a $7 billion market cap. If you look at Lucid Motors right now, Lucid Motors has a $50 billion market cap, and they haven't delivered any vehicles yet either. So $7 billion versus $50 billion, I mean, no one knows which company is going to come out on top, if Lucid Motors is going to be able to deliver, if Fisker is going to be able to deliver. All we do know is that Fisker does have these major partnerships in place with Foxconn and Magna, and this will lead to more vehicles being produced down the road. The partnership with Foxconn will lead to 250,000 vehicles produced more annually, which is half of Tesla's total output. So that's all we know right now. But speaking of Fisker, previously they had been working on a couple of other projects. They had been working on solid-state batteries for the last couple of years. But Henrik Fisker, the CEO and founder of the company, he said that they completely abandoned their research and their furthering along of solid-state batteries, because he said it's the kind of technology when you work on it for years and you get 90% of the way there. You almost have it done, but then you realize that the last 10% is much more difficult than the first 90%. And he said, they don't want to spend the resources, spend the time on actually doing that. So he said they've completely dropped solid-state batteries at this point in time because they just don't see it materializing, and it's really not worth their time and effort right now when they need to be working on actually making the vehicles. They can always outsource the batteries, get them from battery makers like most of the other car companies do. But this is pretty important because it was something they had been working on for years and years, because they had been working on that since about 2018. In 2018, Henrik Fisker said that they had solved some of the problems related to making solid-state batteries. They said they were making progress and we were going to be able to see them soon. But then he just said that the last 10% was much, much harder than they thought, and it wasn't something that they thought was worth the time and the money to actually do. So in the meantime, they've been getting these partnerships with companies like Apple and not companies like Apple, but they've been getting partnerships with one of Apple's partners, which is Foxconn. They also have another partnership with Magna. They say it's much better to use their time working on actually making the vehicles, and they can outsource those batteries. But this hasn't affected their stock price at all. I actually think it's a good move, because it's very easy to outsource the batteries, get them from other companies that specialize specifically in making batteries. And solid-state batteries are still a couple of years out. So when they are available, they can always just buy them and get them, outsourced, sent, and they could use those directly in their vehicles. But at this point, without having even produced a single vehicle yet, that should be priority number one, making the vehicles. And I think this is a good move by them. And investors obviously think the same thing. The stock price has been doing extremely well lately, continues to go up, and completely dropping solid-state batteries has not affected them at all. I think it's a great move. But let me know what you guys think. Do you think it's more important to work on the batteries and make sure you have solid-state batteries, or do you think it's more important to work on the vehicles? Do you think this was a bad move by them? But let me know what you guys think in the comments down below. Comment down below either solid-state batteries was a bad move for dropping them, or if it was a good move. Next up is with a company that I remember a couple years ago when the stock was at $2 a share. It had dropped significantly after its IPO. Remember talking to some friends about it, and Snapchat, their stock has rebounded extremely well since, I think it was just 2 years ago, when the stock price was at $2 or $3 a share at one point. Let's look at it. Yeah, a couple years ago, I think in 2018, it was around $2. Let's look at this. Last 5-year chart. Yeah, it was at, in 2019, okay, it was at $4, a little under $5 a share. And yeah, so it has done extremely well since then. Now the stock price is sitting right around $65 per share. It's continuing to go up. And actually, the company recently announced that it's in a position to drive multiple years of revenue growth of more than 50% year over year for the next couple of years. They said that they've built out its self-serve advertisement ecosystem that has driven the cost per impression for Snap, driven down that cost while we're driving return on investment for advertisers. So it's costing them less money, and it's giving investors a larger return on their investment. So with that combined, advertisers are going to spend more money, and it costs less and less for Snap to actually run these ads and get that out there. So between both of those, it's driving more and more revenue for the company. Everyone knows with companies like Snapchat and Pinterest and Facebook and all of these companies, all these social media companies, the main drivers of growth are advertising dollars. So the way that they could generate more revenue is getting more advertisers, drive down their costs. And right now, Snapchat's doing both of these. They have a couple of different proprietary ways that they can advertise, different types of advertising that they can run versus companies like Facebook. They have a couple of different AR, augmented reality versions of the ads that other companies can't do right now. And also with Snapchat, the news, they have a new Snapchat stories and news feed, which has also been driving major revenue for them. So we'll have to wait and see what happens, but they say their advertising system is getting more and more efficient, and advertisers are making higher and higher ROI. So it's just leading to more and more revenue, and they're predicting more than 50% growth over the next couple of years. But next up is a SPAC that I spoke about pretty recently on the main channel, and a lot of people aren't talking about this stock, and I don't know why, but Payoneer, they're merging with a company called FTAC Olympus Acquisition Corp, stock ticker symbol FTOC. And it's very surprising to me that people are not talking about this more. Payoneer is a competitor to a company, let's say like a PayPal or a Stripe. Payoneer focuses specifically on overseas transactions, transferring, when you pay someone in a different currency and you have to work around those currency exchanges and exchange rates. So they're not exactly the same as PayPal. They focus more on that. But either way, the stock right now has a valuation of about $4.3 billion post-merger. And currently, that's only their sales for 2022 are projected to be around $540 million. The payment growth space, especially online, is growing at an exponential rate, and in 2020, Payoneer was forecasted to handle about $44 billion in payment volumes. That was double what they handled in 2018, and the way they make money is through this something called a take rate, where they take a small percentage of really all of the transactions and all of the dollar amount that flows through their platform. Payoneer, they're forecasting a growth of 25% year over year, which is very similar to companies like PayPal and Square. But I've used Payoneer before. I used them when I paid developers for a startup app I built a while back, a couple years ago. I paid developers in Europe using Payoneer, and it was really easy to use, and I really liked it. And most of the time, I like investing in companies that I've used before that I like and are easy, and this is one of them. So while it is a payment processing company, their margins are very high. They say that Payoneer is predicting that the transaction it says they have about 72% margins, and the company is still predicting 20% to 25% revenue growth over the next couple of years. Either way, though, right now a lot of people are overlooking this company. Most of these SPACs right now have insane valuations that are 50x their revenue 5 years down the road. But that's not the case with Payoneer. Payoneer 2022 sales are $540 million. The valuation is around $4.3 billion. So it's only 8x, and really it has a pretty good valuation when you're looking at the industry they're in. You're looking at online payments and online payment processing, continuing to see that grow. And the company, it's not like it's small. It works in 190 countries worldwide. It handles $44 billion in 2020 in total payment volumes, and it's growing very quickly. So either way you look at it, I think this stock is really overlooked. I think a lot of people are not giving it the attention it deserves, and this is going to be a competitor to companies like Square and PayPal in the future, and it already is. $40 billion is nothing to look down upon that they process every year. That is a significant amount of money, and I just think people are not giving it enough attention. But let me know what you guys think about that. So enough with stocks. We always cover a lot of stocks. I know you guys like those, but let's go into some IPOs. Instacart has been talking about its 2021 IPO for a while now, and Instacart, what happened is they're looking to IPO at some point this year at a $30 billion valuation, or at least around that. Instacart, they've picked Goldman Sachs to lead its IPO, and their business has done extremely well during the pandemic, especially when there was lockdowns. People didn't leave their houses. A lot of people, and they still do, are ordering more grocery deliveries than ever before, and it makes it a lot easier for people who don't want to have to actually go into the store. While the service is, pretty expensive with some of the fees, Instacart, right now, they are doing just extremely well. Their order volumes have surged more than 500% in 2020, and I don't think we're really going to see too much of a decline in that after everything with the pandemic is over. I think once people get it into their routine to just order groceries online, I think we're going to continue to see them doing that for years to come. Because once people get into the routines of ordering groceries online, having them delivered, it's just much easier just to keep doing that than have to actually go to the store. So I think we're going to see them have a very similar situation to what happened with Airbnb and DoorDash and Wish, all of these other tech companies that had IPOs recently. And I think we're going to see them do extremely well with their IPO. One thing to keep in mind, which is actually really interesting, is that the Instacart, they tapped Goldman Sachs banker as CFO ahead of their 2021 IPO. So Nick Giovanni, he currently head of Goldman Sachs Technology, Media and Telecom Group, joined Instacart on January 27th, 2021, and he succeeded Sagar Sanghvi, I probably said that wrong, who has been the startup CFO for the last 5 years. They looked for this guy, Nick, and they're having him is because Nick and Goldman Sachs help take like companies like Airbnb, DoorDash, and other major companies public over the last couple of years. It says Giovanni served as a lead advisor on some of the hottest tech deals over the last few years, including Airbnb, DoorDash, Slack, Dragoneer, and many other companies. So he has a lot of experience in this area, and if they're going public, they want to have someone like that with all of that experience to help them go public, and that is why they brought him on board as of early 2021. So it'll be interesting to see how that plays out. In my opinion, I think that's a really good move on their side to have someone with that much experience be part of their team. Their business is growing at over 300% year over year. I don't think we're going to see too many people leave and stop ordering online once they've already made that transition and made it a habit in their lives to do that. So I think this is a good move by them. And another company that is going to be IPOing, we're going to stick on this is, I think, our last IPO that we're going to talk about, is a company called Hippo. So Hippo was in talks to merge with a SPAC. The deal fell through, and the SPAC is taking another company public. However, we're still going to be expecting, and you should still keep this company on your watch list for 2021, because Hippo, they're an insurance technology company. They're like a competitor similar to like Lemonade, which is an insurance company as well that went IPO, I believe last year or the year before, and they've done extremely well. But Hippo had announced that they will be going public. They sell homeowners coverage, like homeowners insurance coverage online, and it has been growing at a very rapid rate. It grew in the market with last year's acquisition of Spinmaker Insurance. They acquired them, and they've expanded into the U.S. Into more U.S. states, including Maine. So they've been making a lot of acquisitions. They acquired Spinmaker, Shelter, and now they're talking to go public. I think if you're invested in Lemonade and you want to look at another company that is in the similar space, it is like a competitor to them. They don't do the exact same, but they are a competitor to them. I think this is a company that you're going to want to keep on your watch list. They were supposed to go public with the SPAC. They were in talks. The deal fell through, but it's just going to be important to keep an eye out on the company called Hippo, which is an insurance company, over the next couple of months, because we're probably going to see it be going public. We just don't know when, if they're going to do an IPO or a SPAC merger, probably a SPAC merger, but the deal fell through. Just keep this one on your watch list. Okay, so now let's get into some tech news, and then at the end we're going to talk about a couple more stocks. But Spotify is an app that, in an interview recently, Mark Zuckerberg said is probably the app that he uses the most on his phone, other than like Facebook apps, like Facebook or Messenger. And I use Spotify. So many people I know love Spotify. That's their go-to music platform. And Spotify, they are officially launching in 80 new markets across Asia, Africa, the Caribbean, and Latin America. So currently, Spotify is in over 100 countries, 100 markets worldwide. But with this expansion, they're going to be in now more than 180 markets. They're still not in all of them, but now Spotify will be available in over 180 markets in 36 new languages and 60 languages total. And this is going to help their company continue to grow their podcast business, grow more recurring revenue from their premium service, and there still are millions of creators and billions of listeners around the world who don't yet have access to Spotify. They're continuing to work on this, but it's exciting to see that Spotify is continuing to grow, continuing to add more markets to their platform. Currently, Spotify has 345 million listeners, 155 million paying subscribers as of the end of 2020. So this will definitely help increase that. And these are the list of the new countries that they did add. This is like an insane list. Angola, Antigua, Zimbabwe, Uganda, like a lot of countries. Maldives. There are a lot of countries. So if you're in one of these countries, now Spotify will be available. Spotify podcasts, depending on where you are, not all of their content is going to be available for the podcasting. They are going to incentivize creators in other places to get more content on Spotify. But as of right now, they are expanding, and we should see that 155 million paying subscribers increase. And it's just exciting to see that they are continuing to make a major push in the podcasting space, continuing to expand into more markets, and they're really making major moves overall. So I love Spotify. Let me know what you guys think about it. But another company that, another app is with Facebook. So Facebook is launching an app called Bars, and it looks exactly like TikTok. It looks like it's just a replica of TikTok, but essentially what it is it's a TikTok-like app for creating and sharing raps and music. So the app makes it possible for rappers to create and share their raps using professionally created beats, and it's the second launch in the music space for Facebook's R&D team to make a platform similar to TikTok. TikTok has been doing extremely well. We've seen a lot of major artists, whether they're rappers or singers, they've become very popular, started their careers with TikTok. So Facebook is trying to make a platform specifically for these artists on an app called Bars. I don't really know how this is going to work out, because I think the reason why it does so well on TikTok for rappers and musicians is because not only can they share their content with just anyone, but people then make dances or duet videos using someone's lyrics or someone's song or someone's rap. And if it's just if it's just an app for like rappers and that's how they're advertising it, or just an app for musicians, I think regular everyday people probably wouldn't download it. Like, I don't know if I would download it. I'm not like a musician. So I think the key with TikTok for that becoming so successful and for people who are musicians and rappers blowing up on that platform is not because it's just a platform for musicians like Bars would be, but it's because there's just regular everyday people who can do any type of content using that music or that rap. And I think that's what's making these people that's what's like blowing up these singers and rappers, is because it's not just artists on the platform. It's just everyday people, regular people who then could use those songs or use those lyrics or use the raps for any of their content. And I mean, if you look at this looks exactly like TikTok, but just for music. I don't know how it's going to turn out. It's basically the same thing. It's videos that are up to 60 seconds, and I don't know how it's going to turn out. But let me know if would you guys download this app called Bars? It's basically the same thing as TikTok, but it's built for aspiring rappers and musicians. It's still in its beta stages. It hasn't officially launched to the general public yet, but let me know what you guys think of this. Now on to our Bitcoin news of the day. This is always an exciting portion of the episode, and that is that global crypto investment fund, FD7 Ventures, they just sold $750 million worth of Bitcoin to increase their positions in Cardano and Polkadot holdings. So Dubai-based FD7 Ventures, which is a global crypto investment fund with $1 billion under management, just announced that it's selling $750 million, 3/4 of all of the assets under management. They're selling 3/4 worth of all the assets which were in Bitcoin. Now they're selling that, and they're going to be increasing their positions in Cardano, ADA, and Polkadot, which is DOT. This effectively is selling off a majority of their position. I don't know if that means they think Bitcoin doesn't have as much room to grow, because it's increased dramatically over the last couple of months, last couple of years. I don't know if they think that. In my opinion, they obviously see Bitcoin as not growing as much as companies like Cardano or Polkadot. But according to managing director at FD7 Ventures, he said aside from the fact that Bitcoin was the first to market and society has given it meaning as a store of value, I think Bitcoin is actually pretty useless. So that's a pretty big statement. He's basically saying that other than the fact that Bitcoin was first, that everyone knows about Bitcoin, he thinks it's useless. He thinks Polkadot and Cardano and Ethereum are the foundation of the new internet and Web 3.0. According to, he goes on to say how I've been lucky enough to spend lots of time with the brightest minds in crypto, and I'm willing to bet that each of Ethereum, Cardano, and Polkadot will be more valuable than Bitcoin in the next few years. So that's why they're moving their money over. I think this is a risky investment. I don't know a lot about like Polkadot or Cardano, exactly what they do, but all I do know is that he's saying that the founders of Cardano and Polkadot are considered to be some of the most brightest minds working in crypto and developing crypto today. He said that right now, Cardano's team is working towards a blockchain solution to address the needs of millions of unbanked individuals in Africa, and Polkadot continues to build an ecosystem of moonshot projects that enable a fully decentralized platform for Web 3.0 where users are in control. So, in my opinion, I think these are very risky. I think that they could pay off huge, Cardano and Polkadot, just like a lot of these cryptos have. But the downside is you don't know what's really going to come out of them. Obviously, if Cardano, like I said, I'm not an expert in them, but if Cardano is working towards a blockchain solution to help the unbanked population in Africa, that is a large portion of society, not only in the U.S. and in countries all over the world, but especially in places like Africa. So if they're working on solutions for the unbanked population, that could be really huge, especially in Africa as they continue to develop more on the internet and we start seeing e-commerce platforms such as some of the major e-commerce platforms in Africa continue to grow and expand. A lot of these companies are in their very early stages in Africa. So if Cardano is successful, it can be very huge, getting a lot of the population, a lot of people in Africa using Cardano early on when really the internet and everything is really, it's not where it is in the US or where it is in Europe, but as it continues to grow and develop in Africa. So we'll have to wait and see what happens, but that's a pretty big move for a major investment fund to sell 3/4 of all of its assets that were in Bitcoin and move it over to much smaller cryptos. But let me know what you guys think about Cardano and Polkadot. Moving on, we got a story on Li Auto. So Li Auto is one of the 3 major electric vehicle companies in China. Li Auto recently reported their fourth quarter profit and deliveries, and they were very surprising. I actually like Li Auto much better than, in terms of valuation and delivery numbers, I like them, I think, better than NIO or XPeng right now because they deliver almost as many vehicles as NIO. They delivered more than XPeng, yet they have a much smaller market cap than XPeng. And Li Auto reported that that revenue jumped about 65% year over year. They actually reported a fourth quarter profit, which is unheard of in the electric vehicle space right now, especially with all of these startups. And they said they delivered 14,464 vehicles in the fourth quarter, which is a 67% increase year over year. For the full year, they delivered about 32,000. So about half of their vehicles that they have ever delivered were delivered in the fourth quarter of last year. Li Auto has only one model called the Li One. It is the best-selling new energy SUV in China. One thing to keep in mind with Li Auto is that it's not a fully electric vehicle. It is a hybrid. It does have a small, small, what is it? combustion engine to help extend its range. So it's not fully electric, but it does sell a lot of vehicles, and it only has one model. So if you're thinking about it, they sell almost as many vehicles as NIO, which has a couple different models, but Li Auto only has one, which is something I actually really, really like. And another company that recently announced their earnings is DraftKings. So DraftKings, their shares, really there's been no bad news about DraftKings recently. Like every single thing that has come out on DraftKings is really good news. They reported their earnings. They have partnerships with the NFL in both the US and in Canada. During Super Bowl in early 2021, they had like more volume than they've ever had before in terms of payments being run through them. And now the company said that it has about 1.5 million monthly unique payers, and they said that the stock is continuing to do very well. Revenue crushed expectations. Like there was analysts expected $232.6 million in revenue, and they announced it was 322. So this was about, what is that? That's like 25-30% more than what was expected, which is really unheard of. On top of this, they have about 1.5 million monthly unique paying customers. So that means a lot of those people probably pay multiple times, bet on multiple different games. So it's not just, that many transactions. It's unique paying customers. And right now, it says that the average revenue per monthly payer per monthly user, let's just say, is $65. And that's actually a lot of money, a lot of revenue per each person. I think we're going to continue to see this grow, especially with sports betting being legalized in more and more states across the U.S., bills being passed in Canada, and eventually, I think within the next 2 years, we're going to see basically all the states in the U.S. have legalized sports betting. We recently saw Michigan legalize it. We're going to continue to see more and more because it generates billions of dollars in tax dollars for these states. They need the money. This is just an easy solution that is it is just going to happen. It's inevitable that they are going to legalize sports betting. And DraftKings is a major player with partnerships already with the NFL, with major companies, and just they're in a growing market. Right now, only 20 states plus Washington, D.C. allow online sports betting, and 5 states have legalized sports wagering but are not yet operational, and 16 more states are working on legislation. So what is that? That's going to be a total of 41 states that are, so 20 states have already legalized it, already operational. 20 states are already operational, and then another 21 states either have bills that have been passed or bills that are currently being worked on. So it'll be 41 states total probably by the end of this year, and that's going to essentially double the amount of potential revenue for DraftKings. They're predicting that they're going to have between $750 million to $1 billion in revenue for 2021. They said that is dependent on what happens with sports. So as long as we see sports have regular schedules and we don't see restrictions or seasons shortened, then they should have that, which is great news for investors, great news for the stock price. I'm personally invested in them. I like them. I think with sports betting being legalized in more and more states, it's just really hard to bet against this company right now. But let me know what you guys think. Speaking of the stock market, Cathie Wood, ARK Invest, they've just been doing so well. You can't stop ARK Invest, their funds. They've been the best performing ETFs over the last year. And actually, what is important to know about ARK Invest, and one of the biggest risks, is that ARK owns more than 10% of at least 29 companies, and that's pretty important because they don't own a lot of stocks. They own, let's say, between 35 and 50, I believe, in each ETF, about between 30 and 50, and a lot of these companies they own pretty major stakes in, owning 10% of 29 companies is a pretty big deal. In addition to this, they own more than 25% of at least 3 businesses, and they also own 20% of 10 companies. So there's a lot of companies that they're invested in where they own at least 10% or as high as 25% of the entire company. And this is a risk. So it's a good thing if things are going well at the stock market. People put more money in. These stock prices are going to continue to go up because ARK Invest, they have like a limited number of stocks that they really invest in. And if they put more and more money into these stocks, it's going to keep driving the price up. But when the stock market goes down, the risk is if people are pulling out billions of dollars from these ARK ETFs, then ARK has to take money out of these stocks, and that's going to cause those stock prices to go down, causing then the ETF to go down. So it's almost, they can get into a really bad cycle where if the stock market's doing bad, they have to take money out of the stocks, causing the ETF to go down even more, causing people to be worried. So it's really just like a cycle where if things start turning, it could be pretty bad for ARK Invest just because they do have large positions in a lot of these companies. So you just have to be careful with that because if people are taking money out of ARK Invest, they're going to have to take money out of these stocks that they're owning. And a lot of the companies they invest in just aren't massive companies. Like a lot of companies they own are innovative tech companies that are up and coming, but they only have like, I spoke about some on our main channel just the other day that have about a $1 billion market cap, or one that had about a $750 million market cap. And those companies, you know, if ARK Invest takes a couple $1 million out of, you're gonna see the stocks go down, even if nothing happens with them. And there's no bad news. Just because ARK Invest is taking money out or putting money in, because they have such an influence on these smaller companies, it could be a potential risk that you have to just be aware of, because they do own large positions in a lot of these companies. So that's why when ARK Invest was doing extremely well, we saw stocks like CRISPR Therapeutics. It like doubled in a month, and it was one of their largest holdings. So a lot of these companies you're going to see do really well when the stock market is doing well because ARK Invest is pouring more money in. But you just have to be careful because if the stock market goes down, people take money out of ARK Invest, those stocks are going to come down pretty hard as well. So just be aware of that. Something to keep in mind. Now on to something with stimulus. Everyone's been wondering what's going on with the third stimulus package. And the House just passed Biden's $1.9 trillion stimulus package. This is the second largest stimulus package to ever be passed by the House. And it would include a stimulus check for up to $1,400. Now it's on the way to the Senate. It passed in the House with a 219 to 212 vote. And the package is on track to pass the Senate before unemployment benefits expire on March 14th. So this package is called the American Rescue Plan Act of 2021. What it does is it gives $1,400 stimulus checks. It would also extend the $400 per week boosted unemployment benefits until the end of August, allocate money for vaccine distribution, and it also increases the federal minimum wage to $15 per hour. So a lot of Republicans don't like some of the policies in this, but Democrats do have control in the Senate, the House, and the presidency. So it's very likely that we could see this pass pretty quickly, and many people are going to be receiving that $1,400 stimulus check, the third round of stimulus checks. So we'll have to wait and see what happens, but that is pretty exciting news for those of you who are looking for a stimulus check to pay some bills. Now to some legal things going on with Facebook, TikTok, and then we're going to talk about 2 more stocks at the end. So Facebook, recently they had a privacy lawsuit over facial recognition, and it led to a $650 million settlement. It's one of the biggest ever in a privacy suit. And this is a pretty big deal. And it's going to lead into our next story. But so Facebook, they're paying $650 million to users who allege that the company created and stored scans of their faces without their permission. So this lawsuit was filed in 2015, and it's essentially involved Facebook's use of facial recognition technology when you tag your friends in photos, and it recommends, who you should be tagging in the photos because it recognizes the people. It's like this person looks like Jeff, or this person looks like Sally, and it recommends you to tag those people. So essentially what it says is that these users never gave permission for scans of these pictures to be created, and they never got user consent, and it violated Illinois' Biometric Information Privacy Act, which regulates facial recognition, fingerprinting, and other biometric technologies in Illinois. So that was one of the biggest settlements, and essentially it's going to put $345 into the hands of every class member, every person who was part of this lawsuit. But either way, it's a pretty landmark result. $650 million settlement is one of the largest ever for a privacy violation. And this actually leads us to the next story, which is it's pretty interesting and it makes you think. And that is with Facebook weighing whether to build facial recognition into smart glasses. So they just paid $650 million for a privacy lawsuit involving facial recognition, and now they're debating whether or not to add facial recognition into the smart glasses that they are working on. So Facebook is expected to launch its first pair of smart glasses this year in 2021, but the main thing that they've been debating among the team working on it is whether or not they should include facial recognition technology in the product. There's a lot of clear upsides of adding it, but there's also a lot of clear risks. So they said that they're trying to balance these, figure out what's going to be the best solution, because especially with augmented reality glasses, it could be really helpful to have facial recognition to be able to tell you, to be able to help out with what you're seeing. But at the same time, it could cause issues with people stalking. It could cause a number of different issues. So it's just going to be important to see what happens here. This is a really big decision. The upsides is that it could be used to identify the name of a person that you can't remember. They also talked about neurological conditions known as prosopagnosia. Hopefully I'm saying that right, in which a person has a hard time recognizing familiar faces. So it could help with all of that, but also has its downsides of maybe people being able to stalk other people easily, and just other privacy issues if there's facial recognition in the glasses. So we'll have to wait and see what happens, but people on the team are saying this is a major point of discussion, and it's pretty interesting considering they just had to pay $650 million in a privacy lawsuit regarding facial recognition. And now they're debating whether or not to put it in their glasses. Another lawsuit that recently happened with privacy was TikTok. They had to pay $92 million to settle a lawsuit over data privacy. According to the report, TikTok agreed to settle a lawsuit alleging that the app captured biometric and private data from users in the U.S. TikTok, they said that they are agreeing to pay the money, but they disagree with the assertions. And they said rather than wanting to go through all of the litigation, spend all the money on lawyers and just the pain in the neck to deal with all of these lawsuits, they're just gonna, settle by paying the $92 million lawsuit. So right now, all of these technology apps, all these social media apps continue to have issues with privacy, whether that's data, facial recognition, or anything else. But interesting to see that there were talks previously about TikTok with data because they are a Chinese-based company. But interesting to see what will continue to happen here. And last story of the day is with Relativity Space. They recently unveiled a new reusable 3D printed rocket to compete with SpaceX's Falcon 9. And Relativity Space is a 3D printing rocket builder. They're making a huge bet and by developing a fully reusable rocket. And its main goal is to compete with SpaceX's Falcon 9 rockets. These are the rockets that can be used, deployed into space, come back down, be reused multiple times. And they said that it's the same architecture, the same propellant, the same factory, the same 3D printers, the same avionics, and the same team that have built their first rocket. And they said, really, they're just a big fan of reusability. These things cost tens of millions of dollars to make. And no matter how you look at it, even with 3D printing and dropping the cost, having automation, they're still really expensive. And being reusable has to be part of the future of rockets. Whether you're sending satellites into space, whether you're sending people, whatever it is, all of these have to be reusable because it gets very, very expensive to just use a rocket once and spend tens of millions of dollars and never use it again. So interesting to see that. They are competing directly with Tesla, not with Tesla, but with Elon Musk's company SpaceX. And we'll have to wait and see what happens, but I found this story pretty interesting. I've never heard of the company before, Relativity Space. They are not a publicly traded company, but in the future, they very well could be a publicly traded company. But anyways, I hope you guys enjoyed today's episode. Pretty long one. Covered a lot of stocks, a lot of tech news, pretty interesting stories. But if you made it this far in the video, I really appreciate it. But comment down below. I'm looking for something. Comment down below just a emoji of a microphone. So I know you guys made it this far. So just comment down below a microphone emoji. And if you made it this far, I appreciate you guys. Don't forget to get your 4 free stocks, each valued up to $1,600 when you download the Webull investing app using the link down below. I hope you enjoyed, and I'll see you guys in the next episode.